Hello and welcome to the Stockouts. This is your show at FreightWaves for the CPG industry, consumer packaged goods and their supply chains. I'm your host, Mike Baudendistel. I'm the head of intermodal solutions here at FreightWaves. I work primarily on the data side of the business, but also do some content creation on the CPG industry as well as in the intermodal industry. And what I have for you today on the Stockout is I'm going to talk a little bit about Tyson's announcement last week to cut corporate staff. I'll talk a little bit about CPG earnings season, which those results have continued to come in, I think, better than expectations, maybe showing that the consumer is hanging in there and that CPG companies, margins are on the up and up. I'll also talk a little bit about the freight market, provide an update on that from a combination of the data that we have in FreightWaves Sonar, and also some of what my colleagues at FreightWaves have written about. I'll try to curate that to items that CPG companies would care about specifically, or companies that serve CPG companies. So before I do those things, if anyone has not signed up already for the FreightWaves Stockout newsletter, you can do that at www.freightwaves.com/the Stockout. It's also going to be the first one under newsletters. So try to send that out every Wednesday, early afternoon at 2 o'clock Eastern time, and sort of go through whatever is interesting from the world of CPG supply chains, and our freight data. And lately there's been fewer issues with CPG supply chains in terms of trucks not showing up, ingredients that haven't been found, packaging that's not available. So a little bit harder to find things to write about, although I think most CPG companies would take that. But there's still plenty to discuss. And I'll get into the first topic here, which is Tyson announces corporate job cuts. This one caught my attention because I think most of the big CPG companies are not cutting costs. So basically the news was last Wednesday, their CEO, Donnie King, sent out an internal memo that says that they're going to cut 10% of the corporate roles and 15% of the senior leadership position. And when you put that into numbers, Tyson overall has 124,000 employees. Most of those are kind of the rank and file working at the plants. About 6,000 are corporate employees. So 10% if they're cutting, let's call it 600, job eliminations. And so they're also said they're reorganizing the workforce, putting some automation under the engineering, envelope, moving sales under the business and growth envelope. They had announced earlier in the year they're going to close their Illinois and South Dakota offices, moving those people potentially to Arkansas. So hopefully, people weren't relocated just to lose their positions. They also had closed some facilities. So it's part of this sort of pretty, wide reorganization effort. And, found it interesting because, really a lot of the other CPG companies seem to be posting good results. I think the meat segment, meat processors really go under, different sort of market forces, and really was kind of a dramatic, turnaround since the beginning of the pandemic, where, recall the meat processing companies really were posting, very strong margins, growth, very high, pricing power. And it was so high that the Biden administration was convinced that the CPG company or the meat processors specifically were maybe price gouging, and that the industry was anti-competitive because you have those four companies that dominate 80 or 85% of the market, have a graphic that shows the meat processors, net income and how that's risen over the years. And you see that bottom chart, that 2021, that was actually an estimate at the time. This was from the report and whitehouse.gov. The Biden administration put this out to sort of support, as part of their effort to improve competitiveness in the U.S. economy, they needed to go after the meat processors. But that 2021, really an anomaly, because now the profitability in the last quarter was down about 70%, 65-70% for JBS as well as Tyson. And so, really kind of, conflicted with the materials that the Biden administration had put out. So it's not clear that, the administration continues to view that as being an issue. They did invest about $1 billion in independent meat processors that are part of that smaller group in order to try to enhance competitiveness, and just really was kind of one thing that I think the government was premature on. If you want to bring up a stock chart of Tyson Foods, there we have it there. It's really been kind of a round trip during the pandemic. There's a lot of companies you could say were pandemic, round trips in terms of their stock price, but this one specifically, it dipped down. It was about, let's call it $90 at the end of 2019, dipped all the way down to almost $40, shot up to $100. Now it's at $62. So been quite a volatile, situation, which might be great for hedge funds, probably not great for, the management team's blood pressure and the long-term shareholders that like to buy and hold it. But really now, I think the dynamics are the company is trying to streamline their cost structure. I think some of their comments on the management reorganization, if the corporate roles made it sound like they had too many people, it's kind of too much fat in the organization, and so they're going to try to right this ship. They do report next Monday, and it might be one of the only CPGs that has not beaten the estimate. It seems like most of the companies so far have been able to beat Wall Street expectations that have reported their first quarter here in April, either from a combination of very muted elasticities or from margin improvement or just from fewer supply chain issues, which is helping getting these companies products on shelves, as in addition to reducing some of the costs from some exceptions. So we'll look forward to that. I'll plan on writing that up when they report next week. Topic number 2 here, move on to some of the other sort of CPG items. I already talked about a lot of the other companies in the newsletter and on the previous shows of most CPG companies have done well. This earnings season. Unilever late last week was one of the latest CPG companies to show muted elasticities. They had 10.7% price growth in the quarter, and volume only declined 0.2%. So that's not only better than what you would expect based on their history, but better than most other CPGs as well. You look at the whole group, and maybe their elasticity is maybe a 0.35. So for every 100 basis points they increase price, you have about 35 basis points decline in volume. So really not seeing much decline there. And one thing that's encouraging, I think, from the consumer perspective about that 10.7% price growth, yes, it's very high, still up double digits, but not as bad as it has been in the previous quarters, where it had been more like in the 12 to 13% range. I think there was one quarter it was 13.3%. So some of that is just moderating in the cost of the inputs that's being passed on in the form of disinflation or inflation at a lower growth rate. And also some of that is just lapping very high price increases from the previous year. One thing that was interesting is the company talked about its ice cream segment, the volume in ice cream down 4% on a similar 10% increase in pricing. So, there you have a 0.4 elasticity, which just suggests that, you don't have to eat ice cream. It's more discretionary in nature. So it's not that consumers are not under pressure or not, reacting to some CPG price increases. It's just not any worse than I think most of these companies would have expected for or budgeted for. And most of the companies that I've seen report, first quarter earnings have done, better than expectations. Kind of turn to some of the geographies. I mean, most of these companies have been mixed by geography, and Unilever, no exception. They said U.S. sales growth about 8%. They're happy with the India growth of 11.3%. A lot of these companies are benefiting from China's reemergence, which China is just now coming out of the lockdown, or at least had been in sort of the recent months. And so you have that, a lot of just untapped consumer spending power, maybe people who saved money during the lockdown, sort of the way that the U.S. consumers saved money. So I think a lot of good things happening with CPG companies overall. I think the group's in a pretty good spot. From here, I'll turn to the freight market, and if I had to summarize it in one line, it would be that excess truck capacity is absorbing any pickup in demand. Have a chart that from Sonar they want to bring up, and so this is a chart that shows two of sort of the flagship data series from Sonar. So in the white line we have the outbound tender rejection index. This is going to be across all equipment types on the highway, so it's going to include dry van, reefer, and flatbed, and you see it there at 2.9%. That's really close to the all-time low. But what's interesting is when you map that against the blue line there, which is the outbound tender volume index. So that's a measure of demand. It's a tender is a request from a shipper to move a load. And you see that that's actually increased about 6% in the last week. Kind of unusual for that to happen in April. April is usually a slow month for freight. It's usually you would see maybe some surge in March, which didn't take place, but maybe some of that March volume end up moving in April. You can think about things like summer merchandise tends to be bigger. Things like patio furniture, grills, a lot of beverages, produce go into that too. So that's increasing the last week. And usually when you see an increase in demand, you would also see an increase in tender rejections. And so the increase in demand without the increase in tender rejections suggests that there's plenty of excess capacity, even with that increase in demand, and that all that excess demand is being absorbed in the contract market. Not a lot falling to the spot market, so still not going to be a lot of spot activity. And it's just kind of a litmus test when you see tender rejections stay at a low level when you have an increase in demand, that there's plenty of excess capacity. Some other interesting stats here that my colleague Donnie Gilbert wrote up. He says, out of 135 markets, 110 have shown an increase in tender volumes over the past 2 weeks. That supports the idea that this demand increase is widespread, not isolated. It could also be a positive sign for the consumer economy, that things aren't continuing to get worse. That maybe now that inflation is off of its high, maybe it's growing. The CPI 5% is a lot better than 10% plus. That the consumer is still hanging in there. And I think some of the companies that benefit from that are a lot of the companies I talk about on this show and in my newsletter. A lot of these big CPG companies. So continue that. So view that as being somewhat of a positive, but certainly would expect that spot rates to remain depressed, based on that. Another thing that one of my colleagues wrote up, Michael Rudolph, he wrote up this FreightWaves Supply Chain Power Index. I have a graphic on this, and it's a 25. And what that means is that the market power is still weighted towards the shipper. So we do that as a scale from 0 to 100. 0 would mean that the shippers have complete control of the market. Carriers have no pricing power. Shippers can name their price. 100 would mean that the carriers could name their price. I think it's gotten as low as about 15, maybe 20 is the low. So still close to the lowest that we've had it. We'll point out that is a qualitative assessment. I think some of the questions we get suggest that people think we put all our FreightWaves data in some kind of Black-Scholes model and it spits out a number. That's not how it works. It's the research guys look at the data every day, and we talk to companies in the industry, and we sort of qualitatively decide what that number should be. But really, the idea is that still carriers are still shippers market, and the outlook for the coming months is 30. So that's maybe a little bit of strength suggested in the market from a weak level, but still not yet an outlook where it's going to be a balanced market. I want to highlight another article that was written by a colleague of mine, John Kingston, and he put out an article from the TIA, so that's a Transportation Intermediaries Association. So this was took place a week or two ago in late April. So this is a company that TIA it's really the major 3PL conference, and they had some CPG companies on this panel that John Kingston described. I encourage you to go to the site and check this out. It's also linked if you go to Michael Rudolph's article on the FreightWaves Supply Chain Pricing Power Index I was talking to you about earlier. So some of the things that were in this John Kingston article that we're showing on the screen here is, Del Monte was on the stage there. So they went to a 6-month RFP during 2022 when capacity was tight. We've heard that from other shippers, and now it's back to the 1-year RFPs that basically with contract rates starting to come down, they're a little bit more comfortable with those. They want to if possible extend out those contracts for a longer period of time. They said Del Monte was operating in between 800 and 1,000 lanes. that their RFP covers 130 million in freight spend. They say that the shippers are being absolutely bombarded with calls from brokers. So it's the brokers that really sort of desperate for freight. It's pretty consistent with a lot of the articles we've written on FreightWaves.com about all the broker brokers laying people off. And some shippers, I think it was Del Monte, or it might have been another one in that article, said that they are only dealing with brokers that are over about 200 million in sales because they are concerned about the double brokering schemes. And so it does suggest that double brokering is an issue out there. It's more than just an anecdote, and there is some economies of scale of having brokers, up over that, level. I mean, I've heard in the past from brokers that kind of that 300 million sales level is really where you sort of reach critical mass. So I thought that was interesting. Another thing that was interesting is the shippers rank service repeatedly as the number one thing that shippers want. That's something that I've noticed come up, is that maybe price is secondary to service right now, and it's not just accepting tenders. It's on-time pickup and delivery, the level of damage claims. I think it's probably twice as true in CPG, because they not only want to reduce or eliminate the on-time and in-full fees that they could be charged by a big retailer, but those products have to be on shelves in order to keep your habitual customers. It's very easy in CPG for a customer to go from being a habitual customer of one company to a habitual customer of another company just because they went to Target for soap, and they're going to walk out of Target with soap. And if it's not the one they always buy, it's going to be somebody else's. And so much of CPG is just sort of bought out of habit, really, without a lot of thought, given to it until something is not on a shelf. And so, really not surprising that service is number one, and they actually rank safety number two, and price a distant third. So it's something to keep in mind for any kind of carriers and brokers, listening to this, and we'll be interested to hear from any CPGs if they, agreed or disagreed with that assessment. And related to service, you got an interesting question from a Sonar customer the other day, and they brought up the question based on the Intermodal Contract Savings Index, and so I want to put this on there. And so basically, what this is our data team is looking at rail intermodal contract transactions that have been processed in the last week that have a 5-digit origin and destination pair that coincides with a separate transaction that's on the highway. So dry van that has a very same 5-digit origin destination pair that moved on the same week. So you have essentially a 53-foot container and a dry van trailer moving on the highway in the same lane in the same week, and sort of to get at what is actually the spread that we're seeing in the field as far as the discount that is associated with rail intermodal. And you tend to think of, okay, it tends to be about 10 to 15% is typical. So this question from the customer was sort of, at what point do shippers prefer intermodal? What savings do they typically need to see? And I should mention from this chart, the white line is all transactions. The green line is just transactions that exceed 1,200 miles. And really, my response is it depends on exactly what is being shipped, how time sensitive it is. On one end of the spectrum, if CPG company's moving, I don't know, paper towels, and there's plenty of those paper towels in the warehouse, even at parity, they still might continue to use rail intermodal, because that's just inventory in transit that they don't have to pay for in their warehouse, which their warehouse might be full. So it doesn't need to have a big spread, maybe not any spread. But at the same time, if a shipper is moving something that's absolutely critical, that's going to shut down a production line, or it's not going to be on shelves, it's going to move truckload, regardless of how much potential intermodal savings, that savings is not going to be worth it. So it could be a wide range there. I think what's typical is domestic intermodal saving about 10 to 15%. We look at this chart, and overall it's down about it's down to about 9%, which is at the low end of the range. You look at sort of historically based on that same exercise, we're anywhere from that 9% to up to about 20%, which says to me that shippers are not saving a tremendous amount by using rail intermodal right now, and large part of that has been the weakness in the truckload market, and also because the truckload contracts, like I was describing with Del Monte earlier, have been repriced more consistently throughout the year. Shorter term agreements, some of these mini bids. So I think the pressure that's been on most transportation markets has been felt first in truckload side of things, a little bit later in intermodal. So I do think the intermodal contract rates are going to come down, and that spread will gravitate up, but really not a lot of incentive to move, over intermodal versus the highway. Right now, I think when it comes to service, the service is really what causes intermodal shippers to stick with intermodal, whereas the savings rate is really what entices shippers to first, go to use, intermodal. But sort of the phrase you hear is that the logistics manager gets yelled at if they spend too much on transportation costs, but they get fired if those goods don't get to be where they need to be. So really, the safe thing is using truckload, and it's really sort of the burden is on the intermodal participants to demonstrate that the service is truck-like, which is about the best compliment you can give to intermodal service. Last week we had a show on the railroad industry, which I do every Thursday with Joanna Marsh, called People Speaking Rail, and asked Ian Jeffries, who is the president and CEO of the Association of American Railroads. I asked Ian, why hasn't intermodal grown faster than the truckload market the past few years? We go through periods of tight truckload capacity. Why hasn't intermodal been able to take share? And his response was, well, the intermodal, because you have the truckload on either side with the drayage, that was impacted by tightness, just as the truckload has been impacted by that tightness. So I thought that was an interesting perspective, that it's not always one versus the other. It's really that both rail intermodal and truckload rely heavily on truckload industry. This last graphic I want to show is from an article that I would also encourage people to read. It's on transatlantic shipping rates. This was written up, I believe it was published on Friday by Greg Miller. And so he's describing how sort of the gravity is being felt in the transatlantic shipping rates. Of course, it's been some time since the air has come out of the rates in the Trans-Pacific volume. So basically containers going from China and Southeast Asia to the U.S., largely from China to L.A., Long Beach. Those rates have come way down from their highs. And he wrote an article along similar lines earlier, where he was describing that the transatlantic lane, it really had defied gravity for some time. And really the reason for that was that there was more weakness felt earlier in the consumer economy, where those retail inventories got to be at an elevated level. Consumers were cutting back on spending, but that transatlantic shipping volume is more driven by building supplies, and secondarily from things like beverages. Think about like Heineken beer, furniture, mechanical equipment, including auto parts. Think of all the German companies in automobile industry, and Italian companies involved in the automobile industry. So those are we're providing support there. And now with the higher interest rates, you're getting the same drop off in demand in the transatlantic shipping. Not to mention the fact that you can start to redeploy capacity from certain ocean lanes to certain other ocean lanes. So it always did seem like it was only a matter of time before the decline in the Trans-Pacific ocean rates found its way into those transatlantic shipping rates, and we're seeing that now. But definitely recommend everyone follow Greg's articles for anyone that is involved at all in international ocean shipping. Follows that industry very closely, leverages a lot of the data we have in Sonar, and also uses a lot of his own data and numerous industry contacts there. So that's really what I wanted to go over today. As we progress here later in earnings season, I'll continue to go through earnings as they come up on the CPG industry. But that's really all I had today. Hope everyone has a great Monday.